That's what happened.
Sorry, we won't waste any more of your time. Thank you so much. Is that a background or is that really where you are?
That is my background.
Okay.
It's quite lovely. And whereabouts in the world are you? Are you in Zurich? Where are you?
Yeah. Between Zurich and Rapperswil at the Zurich Lake. It's a small town called Männedorf. About 20 minutes outside of Zurich.
Lovely. And is it cold there?
Yeah, I mean, typical for the season, not too cold.
Right, well, let's just we'll kick straight into the meeting. So thank you so much for agreeing to meet with us. We know that your time is precious and we really do appreciate it. So this meeting just forms part of our annual due diligence that we do on all the managers that we have in our clients' funds. So this is my first experience. I'm Diane, and I run the investment strategy here at Definitive Capital, and then I've got my team of analysts with me as well. So we just want to take this also as like an opportunity to learn as much as possible from you. Some of the team members are quite young, and I think, it's always, I've been in markets for 20 years now, and I always find I learn a lot from talking to other managers in the market. So I'm quite excited to pick your brain and learn from you as well. So maybe we could just start off a little bit, just to kind of frame the meeting and where we're going with the meeting. So it's just a little bit to understand like your investment philosophy and your process. So we all looked up your website and we're very interested in what you have to say on the website. You talk about long-term, you talk about undervalued companies, you talk about treating your investors as partners along with you, you talk about long-term shareholding, and those are all like very attractive terms, and they're things that like really resonate with me throughout my investment career. But certain things like undervalued mean different things to different people. So maybe you could just talk a little bit about your investment philosophy, the starting of the fund, and how you kind of run the fund. I mean, I understand from my team that your fund is quite concentrated, so I'm very interested to learn a little bit more about it.
Oh, well, thank you very much for taking the time to talk to me. It's a pleasure to meet you guys all. Before we start, I forgot to mention, I had mentioned to Alex that I like to inform all my partners at the same time to not give anybody an advantage over someone else. And therefore I said, would be okay for us to record this and then to share it with my partners, with my clients. And at the same time, I also want to make the best use of time. So when we discuss things, and I'm sure you're going to have great questions, if I can answer them, I would like to be able to use that material, the transcript, and so forth, so that people who are interested maybe in RICHTWERT and want to know more can do that on their own to a certain degree before they start talking to me, and that way it's more efficient for everyone, I think. Is that okay?
I have no problem with that at all. I think it's a great use of time. Keep everybody on their toes.
Okay, very good. Well, to get back to your question about, I think it was, if I remember correctly, you asked about the investment philosophy, right? Yeah. So the way I would summarize the investment philosophy is investing like an owner. So and it starts with many years ago when I switched from consulting to investment management. I worked at an asset management company. I had read the typical books that you read, read the writings of Warren Buffett, was in the process of finishing my CFA, and was very motivated to start a career in investment management. Had invested on my own for some time, and when I was applying to start somewhere, basically in Switzerland, there are I think 5,000 asset managers, and I was like, hey, this is going to be fertile ground. I'm going to find definitely many that I can apply with, and I was actually shocked to find only a handful were just looking at the website and their communication. I felt like this is investing. There's a concept behind it. There's a methodology behind it. Because a lot of times there's things I read, I was like, okay, but I don't understand the investment philosophy or what they're doing. It just seems like they're picking things and trying things. And I started working at a company that at the time I admired because the founders were very business oriented. Fundamental research was bottom up, analysis was a core, and I started working there, and they had written a book about quality investing at attractive valuation. So there was a lot there to start with. And even there, after getting a little bit more experience and becoming part of the management team and the investment committee, being responsible for investment decisions, I realized that almost nobody actually invests like an owner, right? So you have these concepts of intrinsic value and quality and these kind of things. When it comes to actually constructing a portfolio and making decisions, a lot of times people are like, okay, this is an interesting business model. We don't have it in the portfolio. It would be a great diversification for the portfolio. We're going to add it. And sometimes I was looking at those companies and analyzing them along, and I had to appreciate my analysis came to the conclusion that this is not diversification, it's diversification. We didn't have that business model or that category or industry, but it was also not an attractive one to have. And so there were these kind of things, also selling things that were out of favor, mostly because the way incentives are structured in this industry, of being compared to an index also in the short term, and wanting to secure your income via the management fee. It ties managers' hands behind their backs, because consciously and unconsciously, they don't deviate too much from the index, right? If you do that too much, and there are two things that can happen. Yeah, you can outperform, you can underperform. And when you underperform, if you haven't attracted the right kind of investors and clients, they're going to say, but why am I paying you active fees? Please give me back my money. I'm just going to go into the ETF and invest in the index and do that without paying any active fees. So those were the things where I always had the impression, okay, there's a lot of nice talk and theory about investing like an owner, but or value investing to begin with, but actually putting yourself in the position of an owner and saying, is that the business where I would be happy to have 30%, 20%, 30% of my entire family's asset invested in that business because I believe in that business? And I ask myself, when I invest, for any investment that I take, would I be happy for us to own this investment if stock markets were to close for a couple of years, 5 years or more? Is the asset attractive enough, producing something that I would value even if I couldn't sell for 5 years or more? So I think in a nutshell, it is investing like an owner. And when you start thinking about, okay, what would a rational business person who would want to own businesses look for, everything else follows from that. Obviously, that rational business owner doesn't want to overpay for something, right? So you want to have attractive valuation, and you want to make sure that you have a margin of safety because nobody knows what happens in the future. You may make mistakes, things may happen that are unforeseen, and the world changes all the time, and change is becoming even faster. So you do need to have a margin of safety that protects you when other things happen than you planned. So again, looking from the perspective of an owner, I start with, okay, I want to find businesses that I can understand. With understand, I mean, I have to be able to boil it down to 3, maximum 4 variables. That these variables, the variables themselves, they stay constant. Of course, the value of the variable changes, right? But you want the factors to stay constant, or at least I want the factors to stay constant, because I think if as soon as more than 3 or factors are concerned, right, the probability of being right becomes very small, right? But if you can boil it down and you can say the essence of this investment is, for example, that and that, then you can see, okay, what really matters, and is it going in the right direction or not? Is management deploying strategy that is going to be favorable towards those factors or not? So it reduces the probability of being wrong. That's one. So they have to be simple enough for me to understand, and simple is different for everybody. And for me, it's just, can I understand it? And with understanding, I mean, can I look out 5 to 10 years and say, okay, these are the factors that are going to be make or break, and why do I think that this company is in 5 or 10 years going to be in a better position regarding those factors than the competition? So that's that. That means they have to have competitive advantages. They have to have something that protects it, right? Because we know capitalism is brutal and technology is very brutal. So you have to have something that can make you last. That's the second criteria. The third criteria is I look at the management and what they have communicated. Typically, the companies we invest in have been publicly listed for many years. And the reason for that is I want to see a track record, right? Because talk is easy. What I want to know is, did they make any mistakes? Did they admit any mistakes? What were the plans? What did they actually do, right? And even then, when you have the track record and you look at it and you talk to the company and to management, there's still a very big gray zone. So if you take a normal distribution, right, 90% of it is kind of, yeah, looks like they're honest, looks like they're capable, looks like they're motivated, but I'm not sure. But I can't also say, okay, it looks like they're crooks, right? It looks okay, right? And those I usually stay away from. And I think by now, with the experience that I have, the obvious crooks, I think I do recognize from their communication and from the track record. And then there's a small sliver of management teams where you can easily recognize that they stand out. They're just way above in terms of communication, in terms of clarity, in terms of alignment, in terms of honesty and humility. They're just way above the gray zone that I just mentioned, right? So those are like, it hits you like a hammer. You're like, okay, this is really different and very positive. So those are the types of managements that I look for when I invest for us. And the fourth criteria I already mentioned in the beginning, which is margin of safety. Is the margin of safety large enough to protect us from what may come in the future? Because what I'm interested in for us, I want to achieve attractive returns like everybody else, but predominantly I want to manage risk first. So manage risk, and then I think the returns take care of themselves if you do it well. So the margin of safety is there for that. So in summary, in a nutshell, owner-oriented investing. It's also, of course, long-term, because I think the term ownership kind of implies it, that it's long-term. It is opportunistic, because I don't think I can identify 50 companies that are, my 48th company is not going to be as good as the first 2 or 3, right? So, and the market is often right. It's not like the market is constantly wrong, or not, at least not constantly wrong by a huge margin, right? Occasionally, investors make a mistake, and you get an opportunity to pile up in that investment and do that. And so therefore, it's concentrated, it's opportunistic, it is very flexible. I invest globally. Any country or region where I believe that legal system and protection of capital is given. If that's not given, then we don't invest, no matter how good the business is. Industries don't really matter, because I look at it from a lens of, can I understand the business or not? And there are industries where like biotechnology is not an area of expertise of mine, so I stay away from it. So, but I don't have a preset filter of industry, geography, or market size. I mean, Sometimes the best investments are in the very, very large caps. Sometimes they're in small caps. Sometimes they're in the middle. So it's a very flexible strategy, just trying to see what makes most sense, where we're getting our money's worth, and trying to find situations where the downside is protected and the upside is open.
Yeah, that actually makes a lot of sense to me. But now, so I think the guys told me your investment team, it's you. You don't have a team around you. Is that correct?
That is true.
Okay. Okay, so now that brings me like, I mean, I struggle with this myself. I mean, I've been a global investor for most of my career as well.
Mm-hmm.
There are opportunities out there like you're talking about. I mean, at one stage I worked for a fund which just focused on Africa, and that's completely missed by most people because they're not even fishing in that bucket. How do you have like a way to screen? How do you find these companies of yours?
Well, because I said that they have to be businesses that I understand, the first step is I start with kind of a circle of competence of businesses that I know, either because as a consumer I interact with them, or because beforehand I was a consultant and I've consulted many industries across the world. So there is an understanding, let's say, what you already know. I start with that. And that's kind of the pool where I start fishing. And then with that, you find businesses. Those businesses have customers. If they're B2B customers, then I notice something maybe there. When I analyze the value chain, or they have suppliers, or they have partners, or they have competitors. So, but when I start with what I know, and then the circle expands naturally from their value chain and how they're working. And of course, I read and I consume, and so these are the things that I start with, and it evolves naturally. I mean, sometimes when I run out of ideas, I might run a screener to see, create a pipeline of things that I want to look at, and I'm always a collector. Always very fascinated. Have always been fascinated by business models, strategy, competitive strategy, why businesses succeed, and so forth. So just reading about things and collecting things, and a lot of times I find businesses that I really like, but they are not attractively valued. And you asked about this, like when do you say something is undervalued, right?
Yes.
I think it is very subjective, because it also depends how well you understand the business, right? The more you understand the business, the lower the margin of safety that you need. The less you understand it, the wider the margin of safety needs to be, right? So there's no absolute in that, but yeah, I find businesses where I'm like, okay, I really like this. I need to dig deeper, understand this business better. Or sometimes I understand them, but the future is already priced in, or more than priced in, and then it goes into the pile of my watch list, and I look for it, and I hope that things happen. A good example is a few years ago, I communicated to my clients and partners. I said, these software as a service companies, they are priced as if they are the last ones that are going to disrupt anything. Like they were priced for perfection or above that. So you have to look out decades and extrapolate the growth rates that they had now, with a lot of stock options and so forth being paid, and say, okay, this is all going to work out just beautifully and continue to grow like that, compound like that. And then in 20 years, it is going to be a good investment, right? Well, we know the world doesn't work like that. And nowadays, the mood regarding software as a service companies and software companies has completely shifted with AI. Suddenly people are like, oh, maybe these companies are going to be disrupted. And the valuations have come down 70, 80% in some cases, right? And now I think is an interesting time to look at those and see, okay, which ones do you understand? And are they companies that are better protected from the AI disruption that is coming than others, or not?
So that's a great segue. So I mean, obviously, we've also been watching how software as a service has basically just been decimated. So we're also sort of scratching around there a little bit to kind of find ideas. But now we'll talk a little bit more about software as a service just now. But what I want to ask you is like, so say you've now found, so you're running an equity fund and it's 100% invested, I assume, all the time. Now you want to put another opportunity in the fund. You find something that's suddenly like it's way below your intrinsic value and now it's really interesting. How do you decide in the portfolio what you want to sell? Or how do you think about like the portfolio construction? And I mean, because for me, I also like to hold my companies for a very long time, and then you get quite attached to them, and then it's very hard to do. So the buying part I find quite easy. It's the selling part that's very difficult.
Yeah, no, it is frustrating, really difficult. I absolutely agree with you. And yeah, I mean, I think the best way I describe it is, I mean, is it going to blow me over by being so attractive, either from a quality side or from a valuation side, or ideally from both sides, that I'm willing to let go or reduce a position that I have so dearly kept in the portfolio for many years, right? So it has to be, to me, it has to be so much more compelling to make that switch. But I agree, it's a very, very difficult decision. Also because the positions that you're invested in for a couple of years, you tend to know them better, right? You understand the risks in them better, you understand the opportunities, you know how management operates through cycles a little bit better. So yeah, it has to be so much more attractive. That's the only thing I can say. Yeah, but there's no formula, I mean, I do try to estimate an expected return with conservative assumptions. I compare those, but at the end of the day, it's a qualitative decision.
Great. And then, I mean, you describe yourself as a long-term, like you look at yourself like an owner in the business. And then I'm sure you have this stack. What's your actual average holding period? Like how long do you actually hold a company for?
Well, I haven't calculated an average holding period, but I do know that I think in 2017, I wrote about Blackstone and why it's a great business and greatly undervalued, and we still hold Blackstone in our portfolio. And there are businesses that we're holding longer than that, I think. So yeah, I mean, my holding period is forever. I mean, otherwise I would not invest. And then things can happen, right? I may find out that I was wrong about the quality of the business. The world might change in ways that I did not anticipate. Or as you said, something might come along that is just so much more compelling that I decide to change or sell a position. But I go in with the mindset of holding the business for as long as possible, as long as the thesis holds up, and just enriching our future with the businesses and not by trading businesses.
Can you give us an example of, and this is a difficult question because we don't, as human beings, like to admit that sometimes we make mistakes, but can you give an example of some stock that you've bought that you had a thesis on it that just didn't work out like you thought? And like, what was the process that you went to get into the stock, and how did you realize that it wasn't going to work over time? And what were the trigger points to then sell the stock?
Yeah. We were invested in HelloFresh. It's a food delivery, not food delivery, they're actually very vertically integrated. So they buy things from the farmers and then they create meal kits. That's at least the business they started with. And we had invested, or I had decided to invest in HelloFresh. It was a few months after COVID had started. The business was obviously booming. And I looked at the business, analyzed it, I understood the business. The management had skin in the game. They were the founders of the business. And to me, it had a lot of potential. that business. And we were invested for a few years, and the stock was very wild. I mean, it doubled after we bought it. I reduced some of it, but I didn't completely sell out of it even after it doubled, because the potential for that business, in my opinion, was very large. And the reason was that they controlled so much of the value chain. So they really went to the farmers, and then they delivered to your doorstep, right? So if you manage this amount of the value chain, there's a lot of areas where you can actually capture profit margin for yourself. But it also means that you have to execute very well, right? Because you're dealing with that much of the value chain, and you're not concentrated on a small part of the value chain, right? And we ended up losing a little bit of money because I bought at a price and then reduced when it was twice as much, and then when it went down again, I bought again, and it went to levels that were very low and came up again. So, but to make it short, it wasn't a very satisfactory investment. I think we lost a little bit of money with it. The reason I changed my mind was not because I was wrong about the business potential, but because I had communicated with the management for 2 to 3 years about the way they incentivized people to try the meal kits. I had talked to management about their priorities, because they went also into the ready-to-eat market, which is basically you get the meal, you just put it in the microwave, but it was higher quality than microwave food. And I had argued that they need to create an overall experience, because the meal kits and the ready-to-eat meals, they were targeting different individuals within the family. They were targeting different consumption times during the day, even sometimes different consumption times during the week. And then just to package the food and send it out, that is a fixed cost when it comes to my home. So if I can put more meals in there by combining these things and cross-selling well, that has a lot of potential for capturing profit margin. But they were taking these things individually, and they said, no, they have different target groups, and we're going to market them differently, and eventually we're going to get there where we combine things. So we disagreed on the priority. We disagreed on the way things were incentivized. And that's when I came to the conclusion, after communicating, I think about 2 years with them, and not seeing the actions that I recommended being taken up on, that yes, the business has a lot of potential, but this management team is not going to execute the way I think they should. So that's one of the things where, I made a mistake in believing the management would run the business as rational as possible. But I mean, it's human. People make mistakes. They had skin in the game. They had shares themselves. They were the founders. They did what they believed was right, and I disagreed, and that's where I decided to take our money and go somewhere else with it.
That's fair enough. And then tell me, when you talk about, so one of my own personal investment philosophies is that to me, if you're investing in a business for long term, you're actually investing in the management team. So you really actually have to believe in them. So do you communicate? It sounds like you do, but just know, how often do you communicate with the management of those teams? How long do you have in-depth discussions? I mean, you wouldn't buy a company if you hadn't met with the management team before. How often do you then meet with the management team? That kind of stuff.
Well, it depends. I mean, as I said, I invest in anywhere from micro cap to mega cap companies, and long-term investment of ours is Meta, and Mark Zuckerberg unfortunately doesn't want to speak to me. So
let's see that. Us either. Don't know what's wrong with us.
it's not a hindrance for me. So I don't have to meet with management before making my decisions. And luckily, with the public markets, the amount of disclosure that companies have to give is so much that I find it actually not that hard to find managers that I actually believe in and I would like to have as stewards of our capital on our behalf. I do reach out to investor relations and sometimes to some of the management members if the public disclosure information, if I analyze it and I want to know something more. So I went, for example, to the Middle East in the UAE and just recently spoke to a company because I wanted to find out more and see the people and so forth. But that's more a smaller company. So I think it really depends on the company and the level of clarity that I get, where I think we have a margin of safety that is enough to invest. I don't have to meet the management. Actually, I think in more than 50% of the cases, I have not spoken to management.
And then if I think about like the whole management of companies, I mean, one investor that I spoke to particularly, he similar philosophy to yours, but he was saying he only buys owner managed businesses themselves because he says
he does only what?
He only buys owner managed businesses. So like Mark Zuckerberg, he's the owner of the business and therefore he buys that. So it's a very similar philosophy to what you are doing. Did you find that you overweight in your portfolio owner managed businesses themselves because those managers tend to think very long term about the business, whereas you get maybe a CEO who comes in who's not a founder of the business, and the management team is incentivized differently to thinking a bit more on like a quarterly kind of basis versus long term. This is my family's wealth that I'm growing for 30 years.
Absolutely. No, I think owner operated businesses are an overlooked competitive advantage that I really focus on. That doesn't mean that all of our companies are going to be owner operated. We had for a few years we were invested in Apple. I just looked at the company, knew that Steve Jobs had picked Tim Cook and trained him, and I mean they have to act as owners. It helps a lot if they're actually owners because then they also act that way. But there are also some exceptions where we have a manager that acts really like an owner and is shareholder friendly and does what is right for the business in the long term. But either maybe he or she has a small position in the company, but is not the founder or the founder family. But typically, yes, they are typically owner operated.
Okay. Look at where sorry, I've got a list of questions now. If you think about the turnover in the portfolio, so let's talk about the concentration of your portfolio. How many stocks do you currently have in the portfolio? Do you have a target? And it obviously depends upon the opportunity and the intrinsic value and how far your margin of safety is. So can you talk about how concentrated your fund has been in the past? I mean, I understand from somebody that at one stage you had 5 companies only, but that can vary between 5 and 15. How do you think about that in the portfolio construction itself?
Yeah. So, I mean, I don't think the number of stocks, firstly, the strategy is completely open. It's not only equity. I mean, it happens to be right now only in equity, but the fixed income is more attractive on a risk-adjusted basis. I'm happy to invest in fixed income. What I do not invest in is I limit things, the investments, to assets that produce something.
Okay.
Assets that don't produce anything, in my opinion, cannot be valued. You can speculate on them, but that's not what I do at RICHTWERT. So, but
I'm hearing Bitcoin
And gold.
and gold maybe.
Bitcoin, gold, silver, oil, art, collectibles. Yeah, none of those will ever make it into RICHTWERT's portfolio because I don't think we can value them. And my clients and partners trust me with their capital, not to speculate, but to invest. So that's one. But it doesn't have to be always equities. It can be other things that produce income and can be valued if they make more sense. But since the beginning of the portfolio, and since the beginning of RICHTWERT, I have found equities more attractive to invest in than other things. But this may change tomorrow. I never know. And then the number of stocks or securities, I don't think gives you the answer that you're looking for. Because we have, for example, currently investments where it's like two stocks, but the underlying thesis is very similar. They're actually connected together and so forth. So, but I try to be invested in typically somewhere between 6 to 10 businesses. Sometimes it's more. Right now it's more because I find more things to do. But when it gets to 15 or so, then I think going beyond 15 would be spreading myself too thin, because you have to keep also up with what's happening in the industry, with the competition, how the world is changing, what that means to their business models. And for the type of certainty that I'm looking for, where I can look out 5 to 10 years, it's just very intensive. And that's the number of businesses that I feel comfortable with. And it happens to be a number that also gives us enough diversification, because the businesses that I invest in, they have to go through those 4 criteria that I mentioned before. So, I mean, they are already de-risked from an investment perspective. And then when I can get businesses for 4 or 5 industries from 3 main geographies and so forth, then the combination of everything gives us actually a very good diversification. Some of our businesses are also large, and they themselves are in different sectors and industries, which also, I mean, diversifies that as well. So it's a combination, and then I want the investments also to make a difference, right? I don't want to have too many 1 or 2% positions, because even if they go up 10 times, it's not going to mean that much to the portfolio, right? And the way I size, and maybe this is maybe your next question, but the way I size the businesses is really by the degree of undervaluation that they have. So the more quality we're getting at the lowest price that we can, and the more certain I am about my judgment, the bigger that position is going to become, right? So it's not, I don't believe in long shots. I believe in understanding the business, and when I think it's an attractive business and we're getting it for way below a conservative estimate of intrinsic value, then I think our downside there is protected and the upside is wide and open. And that's when the positions become large.
And you're happy to add to positions and sell out of positions, I assume, and trim positions without selling out of them over time as well. I mean, you mentioned that Meta has been a very long-term holding of yours. And I remember in January last year, it got quite expensive. Would you have trimmed it there? And obviously it had a big blow up in its results in the 4th quarter of last year, and it sold off quite a lot. Would you have bought back then? I mean, are you quite strict about, this is my intrinsic value of the company? If it sells above that, I'll make the position smaller, and if I see a wider margin of safety, I'll top the position up? Or do you just sell directly out of it? Like, how do you think about that?
No, I do trimming based on intrinsic value and the margin of safety that we have. Yeah, and in case of Meta, I did exactly that. When it went above, I think we have been trimming Meta between 500 and above. I mean, they were almost at 800. In that range, we have, further in the past, it was more in the 500 category. And then as we went further along and the business and the cash flows continued to grow, then it was the higher prices. And then when it came down and went below 700, I have been adding. Yeah.
Does the level of CapEx that these businesses are spending, does it worry you? I mean, even Meta has, the business model, we're also long-term believers in the business, but the business has changed like fundamentally because they're spending much more on, these were always asset light, very heavy cash flow, free cash flow businesses, but that's changed a little bit. Like, how do you view that?
Yeah, I mean, capital intensity is important. I do take that into consideration. And on the other hand, of the capital intensity is the return on that capital. And when I think it's a company is throwing Hail Mary passes and speculating, then that's something where I would go away from if I'm invested. Whereas when it's a business where I think the predictability of the returns on that investment are high and positive, then it's not necessarily so that the capital intensity would scare me off. In the case of Meta, to be concrete, I mean, I think they're one of the prime beneficiaries of that AI spend. And a few years ago, people, I mean, when you read the news and analysts, they were saying Meta has lost his mind and is throwing away billions and billions. I was like, okay, this is a person who started from nothing and didn't sell a business for $1 billion when Yahoo wanted to acquire it, and now we're talking trillions. I think I'm going to trust this person when it comes to capital allocation and making decisions, and also pivoting when things aren't working. And this is exactly what he has done over and over and over again. And I don't think it will be different in this case. Actually, we're seeing, I mean, with these kinds of businesses, with the scale that they have, the capital expenditure goes so far. So I think they just have a very good line of sight. Just imagine you have 3 billion repeat customers every day. Yeah. I would love to have that at RICHTWERT.
Us too, really.
Please send them my way.
Believe me, we would as well. Yeah. Tell me, what do you think of a business like Microsoft at the moment?
Yeah, Microsoft, I think at the current valuations, I find it attractive. I mean, first of all, I mean, Microsoft is a dominating business. It's not going to go away. When you see how enterprises make purchases, I mean, as a consultant, I have recommended people other things, and they still went against my recommendations and took Microsoft. So that tells you something. So it's an attractive business, a very attractive business, and the valuation has come down a lot. It's also interesting. Sometimes people punish stocks because they're investing. Sometimes they're very happy. They change their mind very quickly. I remember they did that with Meta when Meta first said they're going to invest a lot, and now they love it. But with Microsoft right now, they don't love it. So to make it short, I think it is an attractive investment. I have not decided to invest in Microsoft for us at RICHTWERT, because right now I prefer the businesses that we own. And it also has to do with the size of the company already. I mean, of course, it's a fantastic business, and it's going to be there in the next 10 years. Yeah, so it's the needle also needs to move, and it's going to move with Microsoft. I just prefer the businesses that we have right now.
Okay. I mean, I found it quite interesting when I looked at the latest Microsoft results. I mean, obviously, they've got a really great data center business. I mean, it was very interesting with Microsoft because it got sold off because it was associated with OpenAI. So OpenAI was amazing in the beginning, and then Sam Altman did that interview on the B2G podcast, and then kind of everybody threw it out. So it was OpenAI negative, and then now it's been thrown out with the software bathwater as well. But if you looked at the results, like the data center business, even though it's a really large business, grew at 39%. I mean, that's a lot of growth for a company which is actually already very big. So, I mean, you talk about moving the needle. To me, that number moves the needle, you know?
I agree. No, I think I think it is a very good investment.
Okay. Then if you just talk about, like, do you, and it's hard to do this, but you are a consumer of businesses, you touch, you eat, you feel, all that kind of stuff. Do you think about things thematically as well? I mean, we like certain things in our fund at the moment, like AI beneficiaries and infrastructure. Do you think about your portfolio construction like that at all? And do you like specific themes at the moment?
Yeah, I mean, I do the analysis purely bottom up. But I mean, I would be amiss to say that, you know what, the things that are happening in the world are not influencing what I'm looking at. So you go to ponds that you find interesting, where you think, you know, there's going to be value to be had. But then it's bottom-up analysis. But I recently send out an email, and I'm not sure if you were on it or not, but if not, I can resend it. Currently, the portfolio, the way it is constructed, I would say right now, I categorize it as 3 buckets. But please keep in mind, this is the outcome.
Yeah,
this is not this is not the way I went in. I went in bottom up, but it happens to be distributed like that, and tomorrow it might be different. Right now, we have 20% of our businesses from a capital allocation that I have done is towards companies that provide infrastructure for AI. And that is an area where I see stability. I see that demand is going to outstrip supply as far as we can see. And it's an area that I find attractive valuations in. Then 60% of our businesses, I would categorize as them having competitive advantages that are strong enough that they will benefit more from AI than others. And in my letter, I categorize it as like this, because my view of change in technology and innovation is different when it comes to investing. I see a lot of investors like to go in those areas for investing because new things happen and growth is fast. I try to stay away from that, because where change happens, predictability becomes difficult. I think you make more money where things are stable and don't change. And now you can say, okay, but AI is going to benefit businesses. I think businesses will become more efficient. Yes. I think they will become more innovative. Yes. I think they will become more agile. But none of this means that they will become more profitable. Because like at a music concert, if everybody decides to stand on their toes to be able to see a little better, nobody actually sees better. Everybody gets tired. Now, the people who were already tall or in the first line, they do see a little bit better.
Yeah.
Right? And that's what AI is going to do to businesses. So I'm looking for the businesses that are already tall or already in the first line, because they have competitive advantages. And then I think they will benefit from AI more than the others. Or AI is not going to make their advantage go away. Right? That's about 60% of our portfolio. And then 20% are things that are pretty out of favor, I would say. So they're typically currently not growing their profits, or if they're growing only single-digit percentage-wise. But the valuation more than reflects that. And they still have competitive advantages where I believe that sooner or later, their growth is going to pick up again. And then given those valuations, I think we have a very good margin of safety, downside protection. And if value picks up, if growth picks up, then I think the valuations will have proven very attractive.
Can you give us an example of one of those companies?
Yeah. So I think one of those companies that we are invested in is Grenke. It's Grenke. It's a leasing company based in Germany, but currently in more than 30 countries, providing leasing for small and medium-sized businesses. And that company was dealt with a few blows a few years ago. that it is recovering from. One of them was COVID. I think actually two things came together. There was COVID and a short seller attack that happened on them, where they basically said all these numbers are made up and not true, and they don't have the cash. So that hit them at the same time, and they, first of all, they had to, I mean, after Wirecard, they had to try to defend themselves, and German BaFin was on them, and they had like 3 auditors in the house that they need to serve. So there was a lot of distraction. That was one. And secondly, they became, I mean, it's easy after the fact to say, you know, they became too conservative and too risk averse with providing leasing contracts, because now we see how COVID developed. But I think when you're in the thick of it, you don't necessarily know how things are going to do. They were too careful in hindsight, and that made their portfolio shrink, the leasing volume shrink, and now they're picking it up again. And yeah, the business is basically priced for no growth. The intrinsic value, if they just close shop today and just executed on the leasing contracts that they already have, so basically just, you know, make sure you collect what you're due over the next couple of years, the business would be worth clearly more than the stock price right now. So I think we have a very good margin of safety, and if the business continues to do well and the leasing volume picks up, or it has picked up, and if they did good risk underwriting, then I think we're getting good value for our money.
Okay. And then just like a question about the future, like say we're sitting here in 3 years' time, I mean, we're going to talk to you on an annual basis, but in 3 years' time, let's just say, for example, the fund has materially underperformed. What do you think the most likely reason for that would have been? Very difficult question.
I think one reason would be underperform. No, I was going to answer something that it would describe the absolute performance, but not necessarily underperformance. For underperformance, good question. If we were, I mean, obviously, I would have to be wrong about the investment thesis and the valuation of the individual businesses that we're investing. I don't think there is a theme. No, I think our portfolio, I would characterize our portfolio as higher quality, and the valuation is lower than the market valuation. I mean, it's not what because I don't do it at the portfolio level, I do it at the individual business level. But overall, I believe that if you add everything up and say this is one company, like the fund is one company, I think it's clearly above average in terms of quality and reinvestment opportunities, skin in the game and competitive advantages, financial strengths, so they can, even if a crisis happens, I think they benefit much more than the average company, and the valuations are lower than the market. So for us to underperform in 3 years' time, I think I have to be just wrong about my assessment of the quality of the businesses and the margin of safety that we have in there.
Now, it sounds to me quite confident of your portfolio that you've got quite a large margin of safety. So I think what I'm hearing you say, you'd be very surprised to see this portfolio underperform materially over I mean, maybe it's something like you get a huge commodity boom and that's the only thing that runs, and maybe you don't have any commodities in your portfolio. Maybe it's some like risk.
But if there's a commodity boom, I don't necessarily think that the businesses like commodity extracting businesses, it's not a one-to-one correlation between commodity prices and commodity extracting businesses. So, and I mean, you would not compare me versus a commodity index, right? There would be like a portion of the companies in the S&P 500 or MSCI World or whichever index you choose that are in the mining business, right? or doing things with commodities. And I don't think there's necessarily a one-to-one correlation. So yeah, I don't know. I mean, if we have technological change, let's say in the life sciences area, like with biotechnology, something happens that is not my area of expertise, and it doesn't become one. Yeah, maybe that. Yeah, and I think also
slightly differently. I guess the way maybe to frame it is, how do you take into account market structure and changing market structure over the last few years into some of your investment ideas, and how long are you willing to give, for example, a Grenke to turn around and perform to your expectations? Because obviously if the stock stays flat for 4 years, it's going to be a drag on performance, which could lead to underperformance. So how long do you give an opportunity set? Because, you know, I think a lot of the value managers we have found over the years have some style drift because they have a benchmark that they have to try and compete against, and market structure has made it that passive flows go into market cap weight businesses, and there's a lot less people looking not for cigarette butt businesses, but for the turnaround story. So how do you sort of take that into account, and how do you change your portfolio based on that?
Yeah, okay, I get the question. I think I'm as benchmark agnostic as you can be. So I do not look at the market structure and whether that will lead us to underperforming or not. And with the businesses, if the stock prices stay low, but the investment thesis holds up and management is doing the right thing, I will not change. I will not drift. What may cause me to make changes, like for example, you mentioned a stock that doesn't go anywhere for 4 years, is the opportunity cost. If I find the business where the intrinsic value is maybe growing by, let's say, 8% a year, the stock is flat, and the alternative is a company where intrinsic value is growing by 25% a year, I will make a change. But it's because of opportunity cost, not because of market structure or benchmark.
Great. And then a last question from me. What's your best idea right now? Can you share that with us?
I could, but I will not.
Because you haven't bought it yet. It's Microsoft.
No, I think the market is just too competitive, and I wouldn't do my partners any favor by sharing necessarily great ideas. So I tend to keep ideas for myself. I provide the disclosure. All of my partners, they see exactly what the fund is invested in, with what percentages, and they can get it even daily if they want. I discourage them from doing that. I tell them, look at it once a year, then you're gonna treat much better than when you look more often. But if somebody wants transparency, I provide transparency. There's nothing that I keep away. But when it comes to my investment thesis, I tend to write about it after the fact. I mean, I do, like, sometimes I say, okay, this is what we did, this is why we did it, but I kind of keep it a little bit at the high level so that my investment about the business. And then I did write, we had 2-3 years where we did not perform as well as the index. And at that point, I felt that I owed it to my partners to explain in more detail why we are invested in the positions that we are, because they have trusted me through thick and thin, and the index has performed for a couple of years better than RICHTWERT did, and I just felt it was the right thing to do so that they know in more detail what they own, and to reward them for their patience. Yeah, but I try to not give away the secrets because it's just too competitive.
I thought I'd try anyway. Thank you so much for your time. I'm going to ask any of my colleagues if they have any other questions. I'm conscious of the time. Anybody? Burning questions?
I missed a little portion. I think just one question that I had in mind. So you mentioned earlier in the interview or chat and on your website that you act alone because you don't want a herd mentality. which is something that we're quite cognizant of, you know, when all of our ideas flow together. So where do you go to find ideas that would challenge your thesis, if you don't have a team around to challenge your thesis?
Well, there are other investors that I respect, that I talk to, sometimes for generating ideas, but I tend to make my decisions alone, so I don't ask them what they think. But after I have made up my mind, there are some investors that I respect where I get their opinion to see if I've missed something. So that's what I do. And then I also use AI as a sparring partner, where I'm like, okay, this is what I think. Why would this not work out? Where do I have a downside that I didn't see? So I like to challenge the ideas and the thesis, but I want to make my decisions alone.
Great. Well, that has been most informative. We really, really appreciate your time. Thank you so much for being so open and forthright.
One question about succession planning. And if you get hit by a bus, what happens to the portfolio? Does it just get wound down? Is there any sort of succession planning?
Well, no, there's no succession planning. RICHTWERT would be wound down. But what I tell my clients and my partners who are invested with me, and some of them have 100% of what they can invest trusted to RICHTWERT. What I do tell them is what I told you in the beginning of our interview, that I pick the businesses we're investing in for the long term. That means my holding period is ideally forever, and I really do ask myself, am I happy with this asset if we can't sell for the next 5 years? So the single captain risk of being run over, they have all the time in the world. I mean, they can sell it down over the years. They can find another manager who's going to take it over. There's absolutely nothing that would cause them to have to make a rush decision.
Great. Thank you very much.
Thank you very much. Thank you so much.
We appreciate it. Have a great day.
Thank you very much for your time. You too.